Welcome back to the Finance Hub, your go-to channel for all things personal finance and investing. In today's video, we're diving deep into systematic investment plans, or SIPs, and uncovering the top 5 strategies to maximize your returns. Whether you're a seasoned investor or just starting out, these tips will help you get the most out of your investments. So, let's get started. SIPs, or systematic investment plans, are no different from other investments. The earlier you start, the more time your money has to grow and benefit from the power of compounding. Think of it like this. You start putting away $100 a month into an SIP at age 20. This small, regular contribution might seem insignificant at first, but over time it can lead to substantial growth. With an average return of around 7% annually, by the time you reach retirement, that small, consistent investment could balloon significantly, providing you with a comfortable nest egg. Now, imagine your friend starts their SIP 10 years later, at age 30. They might be putting in the same amount each month, but those 10 years you had as a head start? That's a crucial period where your investments had more time to grow and compound. That's a huge difference in potential growth, and it highlights the importance of starting early. But it's not just about starting early. It's equally about staying consistent with your contributions. Market dips and fluctuations are inevitable, and it's natural for everyone to feel a bit of panic during these times. However, successful investors understand the importance of sticking to their plan, even when the market is volatile. Consistent contributions, especially during market downturns, can make a significant difference in the long run. When the market's down, you're essentially buying more units at a discounted price, which can be highly beneficial. It's like getting a sale on your investments. This strategy allows you to accumulate more units for the same amount of money. When the market eventually recovers, you're in a prime position to reap the rewards of your disciplined approach. Investing is a marathon, not a sprint. It's about having the patience and discipline to stay the course over the long term. It's about consistency, discipline, and tuning out the noise of short-term market fluctuations and distractions. Start early, stay consistent, and let the magic of compounding work its wonders over time. This approach can lead to significant financial growth and stability. Starting early and staying consistent is great, but diversification is key to leveling up your SIP game. It's not just about putting money aside regularly, it's about making sure that money is working for you in the best possible way. Don't put all your money into one single fund, it's risky. By spreading your investments, you reduce the impact of a poor-performing fund on your overall portfolio. Spread your investments across different types of funds. This means considering a mix of equity, debt, and hybrid funds to balance risk and return. Equity funds have the potential for high returns but come with more risk. They are ideal for those who are willing to take on more volatility for the chance of higher gains. Debt funds offer more stability and are good for conservative investors. They provide regular income and are less volatile compared to equity funds. Hybrid funds blend equity and debt, offering a balance of risk and return. They are suitable for investors looking for moderate growth with some level of safety. Diversifying creates a safety net for your investments. It ensures that you are not overly exposed to any single market or sector. If one sector underperforms, others can cushion the blow. This way, your portfolio remains more stable even during market fluctuations. It's about managing risk and maximizing consistent returns over the long term. A well-diversified portfolio can help you achieve your financial goals more effectively. How you diversify depends on your risk tolerance, investment goals, and time horizon. Each investor's strategy will be unique based on these factors. Younger investors might prefer more equity funds, while those closer to retirement might lean towards debt funds. Your age and financial situation play a crucial role in your investment choices. Diversification isn't about eliminating risk, it's about managing it intelligently. By spreading your investments, you can better handle market volatility. Build a diversified SIP portfolio that aligns with your financial goals. This approach will help you navigate the ups and downs of the market while working towards your long-term objectives. Market volatility can be nerve-wracking, but with SIPs, you can use it to your advantage. Instead of fearing the ups and downs, you can turn them into opportunities for growth. One of the biggest benefits of SIPs is rupee cost averaging. This strategy helps you navigate the unpredictable nature of the market. By investing a fixed amount regularly, you buy more units when prices are low and fewer when prices are high. This disciplined approach ensures that you are not swayed by market emotions. This averages out your purchase price, potentially giving you better returns. Over time, this can significantly enhance your investment portfolio. Take it to the next level by increasing your SIP contributions when the market dips. This proactive step can amplify your gains. It sounds counterintuitive, but buying more at a discount can lead to higher returns when the market recovers. This is a smart way to capitalize on market corrections. Timing the market perfectly is impossible, but increasing contributions during dips can be smart. This strategy leverages the natural ebb and flow of the market. Don't dump all your savings into the market during a downturn, but if you have extra cash and are comfortable with the risks, consider increasing your SIP contributions. This balanced approach can yield substantial benefits. This strategy can help you buy more units at a lower price. The more units you accumulate at lower prices, the better your potential returns. Over time, this can lead to potentially higher returns. Patience and consistency are key to making the most of your SIPs. Remember, market volatility is part of the game. Embrace it rather than fear it. Use it to your advantage with SIPs. By staying committed and strategic, you can turn market volatility into a powerful ally for your financial growth. Investing without clear financial goals is like setting out on a road trip with no destination. Every investment, especially SIPs, should have a specific financial goal. Are you saving for a down payment, planning for your child's education, or securing a comfortable retirement? Clear financial goals give you direction and keep you motivated. When you know what you're working towards, it's easier to stay disciplined. For example, if your goal is to buy a house in 5 years, you know how much you need to invest each month through your SIP. Each contribution is a step closer to your dream home. The same goes for any other financial goal. Define your financial goals before setting up your SIPs. Be specific about what you want to achieve, how much you'll need, and by when. You've started early, diversified, taken advantage of market volatility, and aligned your SIPs with your financial goals. But investing isn't a set-it-and-forget-it deal. The financial market changes, and so might your investment needs and goals. Regularly review and adjust your SIP portfolio. Think of it like a checkup. Review your portfolio at least once a year. Check fund performance, financial goals, and asset allocation. Adjust your portfolio based on your review. This could involve reallocating funds, changing SIP amounts, or switching to different funds. Reviewing and adjusting your portfolio isn't as complicated as it sounds. There are resources and financial advisors available to help. And there you have it, the top 5 strategies to maximize returns on your SIP investments. Start early, diversify your portfolio, take advantage of market volatility, align your SIPs with your financial goals, and regularly review and adjust your portfolio. By following these strategies, you can make the most out of your investments and work towards achieving your financial dreams. If you found this video helpful, don't forget to like, share, and subscribe to the Finance Hub for more insightful content on personal finance and investing. Leave a comment below if you have any questions or topics you'd like us to cover in future videos. Thanks for watching, and see you in the next video.